Three is financial analysis of accounts receivable. We have one objective. You need to be able to calculate and analyze accounts receivable turnover ratios. So the number of times the average amount of accounts receivable is collected during a specified period is called our accounts receivable turnover ratio. So what we do is we're going to take our net sales on account divided by our average book value of accounts receivable, and that's going to give us our accounts receivable turnover ratio. Okay, then we also have this days sales in accounts receivable. The average period of time to collect an account receivable is called our days sales in accounts receivable. So this, we're going to take days in a year divided by our accounts receivable turnover ratio that we figured out up here, and that will give us our days sales in accounts receivable. Okay, so analyzing our accounts receivable ratio, it says a turnover ratio of 12.0 times means that a company receives payments on an average of 30 days or 365 days, 12.0 accounts receivable turnover ratio. Since these data are higher than the company's credit terms of 210 at net 30, the company should consider implementing some actions to improve quicker collections. However, a business must weigh a change in credit policies against the effect the change will have on total sales. So really what this is saying is since the average days is 30 days, that they're looking at maybe doing something different for that credit to increase people paying sooner so that they can get their money quicker. But we always have to make sure that we're looking at both sides of that. What will that do to help, but also what could that do to hurt the business? Actions to create more favorable accounts receivable turnover ratio. So here are some things that a company could do. They could send account statements to customers more often, including a request for prompt payment. Not sell on account to any customer who has an account for which payment is overdue more than 30 days. So if that customer owes money, they can't sell on account to them anymore. Or conduct a more rigorous credit check on new customers before extending credit to them. So making sure that they're really doing a good check before they say, yeah, we'll sell to you on account. All right, number one, what is the formula for calculating the accounts receivable turnover ratio? We're going to take net sales on account divided by the average book value of accounts receivable, and that will give us our accounts receivable turnover ratio. Number two, how would you interpret the situation of a business that desires an accounts receivable turnover ratio of 12.0 times, but actually has a turnover ratio of 6.0 times? So what that's telling us is that customers are taking about 60 days to pay their accounts. And the business somehow needs to figure out a way to encourage prompter payment in order to reduce the number of days to receive payment to 30 days. So that might be where they try some of those things to increase those favorable accounts receivable turnover ratios. So maybe sending out statements more frequently, not letting people buy on account if they already have money that they owe, or doing more thorough background check for credit check before they let them buy an account. Number three, how can extremely restrictive credit terms have a negative impact on a business? So one thing that a business might look at doing is if they're not getting their payments promptly, they might look at being more restrictive on who they let buy on credit and maybe how they expect payment back on credit. Now, the problem is that businesses can be lost, or business can be lost, as some customers may buy from competitors that have less restrictive credit terms. So if you're looking at a business that will offer you the chance to buy on account versus one that won't offer you that option, you might go with the option of being able to buy on account. So you have to think about that too. Yeah, we want to make sure that we're promptly getting our money, but could this deter customers from buying from us? All right, that is the end of 6.3. So go ahead and go on to your 6.3 work together.